All right, we've got Greg Parham, the attorney for First Alliance Title. This guy is a genius, and he's talking about creative real estate from an attorney's perspective. You're going to learn a ton by sticking with this lesson, this episode. So without further ado, here's Greg Parham.
I feel like a rock star with this thing.
You should start singing.
We'll see if it works. Can you hear me? Is that right? Because I kind of talk soft. You can't hear me back there, can you? All right. So, my name's Greg Parham. I'm a real estate attorney. Been in practice since '94. I have owned 2 title companies. I owned one for about 7 years and sold it. I started First Alliance Title in 2014, and so April of 2014. So I think we closed 3 transactions that April, and I think this last month we closed more like 175 deals. So my focus is, what I like about my practice is working with investors, because the typical sales are just cookie cutter sales. They're all the same. They all work the same. So I've started with some of the bigger known wholesalers in town that you probably know who they are. Did their first subject to transactions for them. Do a lot of wraps, sub twos, those types of things. So I've seen all kinds of different creative transactions, and if you ever have a question about them, let me know. So what I thought I'd do for the presentation today is make it a little bit more interactive. So I have a list that I brought with me to kind of help us along, but that list is divided into 2 things. One is things I think investors need to be aware of, especially what you guys call creative investors. What I call creative investors just means you're trying to use somebody else's money, right? Isn't that really what creative investing is? You don't want to use your own money, right? Okay, so let's just be honest. Investing without using your own money. So I have a list of things that you need to be aware of to keep yourself out of trouble. And then I've got a list of things that really work well. So different transactions and structures that, if you haven't heard from them, I'd be happy to kind of walk through those structures. But besides that list, I'd like to just get questions from you guys. So we can do this a couple of different ways. I can start on my list, or if somebody's got a burning question that they're just really struggling with, they can raise their hand and we'll talk through that, and I'll try to weave the other things in as we talk through that. Want me to start with the list?
Yeah.
Okay, start with the list. So this is a big list. Okay. Be aware. How many of you work in foreclosures? Or people that are late or behind on their payments? Anyone? Okay, raise a high. How many, like 2, 3? Okay. And I'm not talking about they're in foreclosure. I'm just talking like maybe you pick them up on a late list, or maybe they're just 30, 40 days late, that kind of thing. Anybody working with those types of sellers? Okay, so one of the beware things you need to know with those sellers is there's a statute in Colorado called the Colorado Foreclosure Protection Act. Has anybody heard of this thing? Okay. You need to know this statute, because have you heard the circumstance where, let's say you're late on your payments, and I'm coming to your door and I'm saying, look, I can save you from this. How about I just get a deed from the property, I'll pay you 10 grand, and I'll cure that foreclosure right now, and then you can rent the property back from me, and I'll own it, and if you want it back, you can just buy it back with an option. Anybody heard anything like that? Okay, so that's, if you're hearing that that's something to do in Colorado from someone, run away really fast, because it's a very dangerous area. The Colorado Foreclosure Protection Act protects people that are in foreclosure, meaning they're just 30 days late. That's it. It doesn't have to be an NED filed, just they're 30 days late. So whenever you're working with somebody that's living in their residence and you think they might be late, you need to use a special contract and go through some special processes. If you don't, you can end up wearing a little orange jumpsuit and asking for permission to go out in the yard and exercise, if you get my drift. And the other thing that can happen is the seller can void the transaction even after you've made all those payments and done all those things. The seller can go, you know what, I think you violated the statute. I'm just going to take everything back. So, any questions on that?
Have you seen that, Fred?
Have I seen that? Yeah. Yep. Okay. No questions on Foreclosure Protection Act. Right. Good. It's interesting. I just came across one yesterday where somebody had done that exact same thing. And it was a quitclaim deed. And they are probably going to be hearing from the Attorney General.
Okay.
Yeah. Yeah.
Do you know across the country how other states have this?
Some other states do, not all of them. So that's the problem, is people will have some training in another state, and then they'll come to Colorado, and they've been doing this legally in another state without a problem. They come to Colorado, and they just don't know that they're stepping in it. That's kind of the problem with it. The statute was developed by after this guy named Ryan Searle. Anybody remember that name? It might be like almost 20 years ago. Kind of dating myself. There were 2 full-page spreads in a paper that we used to have called the Rocky Mountain News. And Ryan was a guy that was an investor, and he would go after people in foreclosure, and he would legitimately buy their house from them and let them rent it back with an option to purchase it. But then they couldn't purchase because, life happens, and they couldn't make their rent payment, and so then he would evict them. And so he'd get these houses a really good deal. He was very creative with it, and but he was messing up along the way, like having documents notarized at his office that nobody was there to sign, those types of things. But anyway, the idea of this happening kind of caught the attention of the legislature, and they said, we can't let this happen anymore, so we have to make this statute to protect these people. So that's what the statute's all about. All right. Any other questions on that? Okay. Disclosures. So one of the things that I think investors are sometimes worried to do is disclose what they're doing. How many of you are wholesalers? Yeah, and you guys, you wholesale off the MLS, so it's not that big a lot of the time. I know you do privately too. But when you're doing private wholesaling, what I mean by you're talking to a for sale by owner, and you want to put their property under contract, assign that contract to somebody else, or flip it to somebody else the same day, like a double closing. You guys hear this? Anybody like this and want to do this? Okay. So one of the things that I would encourage you to do is put in your contracts exactly what you can do. Your contract will say, and in the contract it will say, by the way, seller, I may turn around and sell this property the same day that I buy it from you for a profit, and you don't get any of that money. Right? And those types of disclosures, a lot of people will think, oh gosh, I don't want to tell the seller that because then the seller won't do the deal with me. It's not true. The seller wants to do a deal with you because you're their best option, usually. And they've looked at other options, and they'd rather just sell to you. Okay? That's usually the case. But if you don't put those disclosures in there, and then they find out later that you made this huge spread on their house, lots of times they get angry. And when they get angry, then what do? They call the police. And they call bad people to come get you, or good people to come get you, whatever you think. And you may be doing something completely legitimate. There's no problem to buy a property and turn around and sell it to you the same day. Absolutely nothing wrong with it. What I'm telling you is, the more disclosures you have, the better you're going to be able to do this in the long term. You don't want to be the 5 times an out wholesaler. You want to be somebody that can be doing this for a number of years, because there's some great money in it, but you just have to do it right. That make sense? Yep. Okay. Another one is, don't be a real estate broker if you're not a broker. Okay? So it's Amy, right? Amber. Okay. So let's say that Amber's got a house, and I'm going to buy it, and I'm like, hey, I'm an investor. I'd like to buy your house, and I may sell it to somebody else or assign it to one of my my partners or something, are you okay with that? Are you okay with the price? Amber says, yeah, it's okay with the price. So I say, okay, well, I'm going to talk to you next week. And then I go to the group like you guys and I say, hey, I've got this property. It's a 3-bedroom, 2-bath, blah, blah, blah.
Can you do a sandwich, or is there any way to do something similar to that?
A sandwich, yeah, so that's a great question. So let's say I've got my option, and I can exercise my option, and at the same time, I can turn around and sell it to you. That's a sandwich lease option, or maybe I lease option to you. And so that's the sandwich. We've got 2 leases, right? And so I'm leasing it with an option to purchase, and maybe my option to purchase is $200, yours is $250, so I'm going to make that spread, right? You can do that. They're difficult to do for financing reasons. We used to do those all the time back in the 2000s, because at that point in time, I could buy that property from Amber, record my deed, and I could sell that property immediately to somebody else with financing. And now the banks don't like that kind of a deal because the title hasn't seasoned long enough. They want to make sure that I've owned that property for a while before the bank will loan the money on it. So the sandwich lease options work really good for cash flow. So if I'm leasing and I'm leasing from Amber for $1,300 a month, but I'm turning around and leasing to you for $2,000 a month, and I'm making that cash flow, that's fine. But don't really bank on that ability to close the same day with a lease option unless you're buying with cash.
After doing that, in how long can you sell it and don't get any penalties? Or you can't do it?
What do you mean?
They said they lease it for a certain amount of time, 6 months or a year, then you can sell it and
Oh no, usually with a lease option I can lease it for a day and turn it and sell it. Yeah.
Oh, okay.
Yeah.
Good enough.
You see,
It's a
can
great-
without a license, you mean a broker's license?
A broker's license, yeah. Yeah, the option dealer thing is a broker's license, yeah. Any questions on that? Okay. Installment land contracts. Anybody do installment land contracts? So these are huge, and I see them less and less. So the installment land contract works like this. You sell me your property, and instead of me just, it's a form of seller financing. Instead of me just buying it outright and paying off your underlying mortgage, I'm going to have a contract with you where you sign over a deed and somebody holds that deed in escrow. Sorry, it's my wife calling. And somebody holds that deed in escrow, and I'm required to make umpteen number of payments, and then once I make that final payment, I get the deed. Okay? Different than a typical mortgage. A typical mortgage is I get the deed right away, and then I've got this lien against the property until I pay off my mortgage. So installment land contracts were a really, really, really good way to pick up properties and to sell them. But the downside was, whenever you do them, you have to do them really carefully. Otherwise, they can be unwound. And most of the time, people messed up in the paperwork and the tax escrows with the county. And so when they did that, there were some attorneys in town that would look for these types of transactions and then contact the sellers and say, "Oh, by the way," or the buyers, "Do you want to undo this transaction? Because it wasn't done right. We can undo it. They can't hold you to it." So I'm not a big fan of installment land contracts, so I would stay away from those if I were you guys in creative financing. What else? Oh, joint ventures with owners. Has any fix and flipper had the idea where you got an owner that understands that if you can just fix this property up and sell it, maybe you can divide the proceeds with the seller, right? Yeah. And some people have done that really successfully. I would say that you got to be really careful with it because what can happen is you have this idea that you're going to fix it up, and then the owner decides, well, I don't want that kind of countertop, and I don't want those kind of cabinets, and I think you spent too much money on this, and suddenly you're in this dispute with this owner, and guess what? You put all the money in, right? And guess who's still on title? They are. And you can't just magically get them off title. And you've sunk all this money into it. So you have to do it very carefully. And so what we've done when we've done those types of transactions is we actually have a performance deed of trust that's done, a construction management agreement and all that kind of stuff. So they can be done, but be careful of those because it's a really easy thing to talk a seller into because they're like, hey, yeah, I'm still in control. The same dad, you're going to fix it in my house. You have all the trades. You're really good at that stuff. And we'll maximize the price and sell it, and I'll take a little bit of profit. It's much better for you if you just buy the property subject to, or to buy it outright, and maybe have them carry a note that at the end of the day, when you sell that property, they get paid an amount. But it's a fixed amount that you guys have already agreed upon. And that way, they're not in control of your business, but they're still going to get their payout when you eventually sell. It's a really good structure to do that. Okay? Any questions on any of that? Stuff. Let's talk about stuff that works. And I'm going to talk about buying and selling residential. Yeah.
When you do subject to, do you always put it in a trust or what kind of?
No. Let's talk about subject twos. Okay. So first, I want to break down what a subject to is, just in case there's people in the room that doesn't know what one is. So I am buying your property, and there's a mortgage on it. And subject to just means it's subject to that deed of trust. So if I don't make the payments, or you don't make the payments, or somebody doesn't make the payments, the lender's going to foreclose. It's a fantastic way to get into a property because maybe you have had that mortgage for 20 years. And now I'm buying your property subject to that mortgage. With a 20-year mortgage, how much of the percentage of that principal or that mortgage payment goes toward principal versus interest? A whole lot, right? Versus the first year of the mortgage. So if I buy a property that's worth $200,000 and I'm buying it subject to a loan that was just taken out yesterday versus one that was taken out 10 years ago, the 10 years ago deal is way better than the other one because now every single payment that my renter makes that goes toward that mortgage is really paying down a ton of that principal. So it's really, really great system. Subject twos are fantastic. So, and the way you do it is you have a contract that says you're going to buy it subject to that existing financing, and then a deed is transferred to you, and you close it just like any normal transaction at the title company, except you don't get a payoff. You don't pay off the loan. That's really the only difference. There's some disclosures that you have to do. You have to tell the seller, hey, by the way, seller, your loan's not going to be paid off. It's going to stay on your credit report for however long it's going to be there. And also, you've got a disclosure about the due on sale clause. This is kind of what your question is related to, the due on sale clause. Every deed of trust has a clause in it that says, if you sell your home, the lender has the ability to accelerate the note if it's not paid off. Because the lender doesn't want somebody else that didn't qualify for the loan to be in that house, right? So they've got this clause that says, if you sell and you don't pay us off, we can, if we want to, accelerate the note and make you pay it all in full. It's not that they're required to. It's not that you can't sell your home unless you pay it off. It's just if you do sell your home and pay it off, or don't pay it off, they've got this option that they can accelerate. That's what most investors are worried about when they buy a subject to place is, oh gosh, now what if the bank calls the note due? Okay? So a lot of investors have thought of all these creative ways of pretending that the house really hasn't sold to anybody. It's really still in the name of the seller. So they've created these trusts that look like the seller's trust so that when the bank comes calling and says, hey, was there a transfer in the title, the seller can say, or the new trustee can say, oh, no, this is just a transfer into the trust. Okay? Don't do that. Don't do that. Don't do anything to commit loan fraud. Because as soon as you lie to the bank, you're conspiring for loan fraud. So I am going to tell you that when it comes to the due on sale clause, this is my advice to you. Who cares? Okay? If I buy a property subject to the existing financing, when I buy that property, it has to be a good deal, just like any other purchase you make. So I look at the worst case scenario, just like when you're doing a fix and flip. You put a margin of error in there, you see what all your stuff's going to cost, and you look at the worst case scenario. What's the worst case scenario on my after repaired value to sell this house, right? We always look at our worst case scenario. And if it's not a good scenario, you say, I don't want to do it. Same with subject twos. So if I were doing a subject two, I'm going to buy the property subject to, knowing that my worst case scenario could be that the bank calls me up and says, hey, we noticed that this property was transferred, and we're going to exercise our due on sale clause. And so I have to sell it or refinance it. Okay? If I'm buying the subject to in a way that's going to be profitable for me, I don't care whether they exercise their due on sale, because I can sell it for a profit immediately, or I can refinance it. It doesn't matter to me. Now, if I'm buying a subject to that I have to sink $30,000 into, and I have to hold it for at least 10 years to make my money out of it, that's not a good subject to. It's just a bad deal. So that's why I say, who cares about subject to? The other reason I say who cares about subject to is the banks just don't exercise the due on sale clause. A lot of people will say, well, surely if the bank finds out, they're going to foreclose because they want to then be able to charge a higher interest rate. Not true. Banks don't want to foreclose. They like to receive payments all day long. They like having performing notes, performing assets, positive bank balances. They like those things. So you don't have anything to hide. Put it in your own LLC name. When you buy it subject to, you don't have to worry about a trust. You send the bank a notification with a power of attorney from the seller and an authorization from the seller to send you all the statements, and it works beautifully. There are some lenders under certain programs, like rehab loans and things like that, that under the charter of those kind of nonprofit programs, they are required to call the note due. And those are usually junior liens of a very small amount. I've had investors that have bought those. The lender said, we're going to call the note due. And the investor said, really? You're going to call this note due? This is a $4,000 note. You're going to call it due? Go ahead. Try to foreclose. And they never did. And it was one of those notes where you only have to pay it off if you sell the property. So he's never been pursued under that note. So any questions on sub-twos? Yeah?
How do you handle insurance, especially when it's an escrow?
Great question. So the way you handle insurance is really simple. You just go to your insurance company, whoever you use, and you say, I bought this property. I need to have this other lender insured, just like with your current mortgage. And I need you to send the declaration in there to show that it's insured. And then what they do is they just change it out now when the escrows is paying your insurance company instead of the old one. Will it notify the bank that the property's been transferred? Maybe. Never does. Never bothers them. The other way to do it is to contact the current insurance company and say the same thing. I need to get the old seller off and put me on because now I'm the insured. What you don't want to do with the insurance is just leave the current insurance in place. Because the insured under that is, Sally Seller, not you. So if the house burns down and there's a claim for that insurance, there's no... One of the requirements of your homeowner's insurance policy is that you actually own the home. So if there's a claim, you're not going to get the house covered because you're not an insured and you need to be. Okay.
So do you ever leave them as an additional insured?
Nope. I don't want the seller as an additional insured. Why would I, if I have let's say it hails in Denver, right? This is a good spot for it too, right? I get the check from the insurance company made out to the insureds, and I have to have it endorsed over? I don't want to chase that seller down across the country or in another country and try to get that check endorsed. It's hard enough to get the lender to endorse it to send it to you for the roof repair. So no, I would not add the seller as an additional insured. The only time I'd add the seller as an additional insured is if I did a wrap transaction where I have a new loan to the seller. We can talk about that too. Another question on sub 2s over here. Or did that cover it? Yeah.
Well, you just said you'll send the first lien bank power of attorney signed by the seller, and what else?
Yeah, so the way I structure these is we'll send them, when we close, we'll send them a letter. That's a notification letter that says, hey bank, it's signed by the seller. Start sending statements to the grantee, so-and-so. Here's the information. And then I include a seller's authorization form to do that, and a seller's limited power of attorney that allows this new buyer to access the loan information, and that's it, just the loan information. So they, sometimes the banks will make it really difficult for a buyer on a sub 2 to actually know what the mortgage amounts are and to get the statements. And what can happen is if the escrows change and taxes go up or whatever, and your payment is only the old payment, now you're in default and you might not know it for a year until they start to foreclose. So I had that happen to a subject to investor where like a year later she finds out that the escrows had changed and they're foreclosing, and the house was worth what she had into it, and she was just like gonna let it go. So yeah, good question. Yep, another one? Sub 2s? Yep.
I'm curious from the seller's perspective why they would be willing to do this.
Great question. Does anybody do sub 2s here? Does anybody do subject to transactions here? Okay, I'll tell you why they want to do it. Their life circumstances require it. So there's a couple different situations. One is they realize they're not going to make their payments because they can't. I can't make my payment. You might as well just take it over. If you can give me $10,000 so that I can get out of town and you take over my payments, fantastic. That's one. Another one might be if they're actually leaving town, getting transferred or whatever, and they don't want their house. If they just bought their house recently, we've run into this a lot, and they really can't sell it and make money off of it. So they will go ahead and do it. They don't want to rent it. So they might be looking at the situation saying, you know what, we don't want to rent this house. What a pain to rent a house. I don't want to rent a house. So you're approaching them saying, hey, how about I just take over the payments, because I'm good at getting renters, and I'll take over the payments, and I'll pay you $10,000 to be on your way, and it works out really well. So those are usually the two types of circumstances where sub 2s work great. But your question is really a good one, because with a subject to transaction, it can be really harmful for a seller. So if you buy that property and then you don't make the payments, they're going to have a foreclosure on their record, right? And if you're not making payments with a straight subject to transaction, they don't have any recourse to come back and say, give me my property back because you're not making payments. That would have to be like a wrap, where they do have that kind of recourse. So it can be dangerous for a seller, obviously. So what that means for me is my seller has to tell me that that's what they want. You're laying out the options of how you can buy the seller's house, and in my mind, they need to talk me into buying it subject to. Like, hey, you might not want to do that because of these reasons. It's going to stay on your credit report. It's not going to be paid off for a long time, and I'm only going to be able to give you X dollars. Are you okay with that? And if they're saying yes, 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 that's usually when the subject to works great. Does that make sense? Like, have the seller talk you into it.
How do you find people that are in that situation? Are they popping up on lists somewhere where you're like, oh?
Yeah, that's a really, there's a lot of magic to direct marketing, and a lot of people have different secret sauce for doing that. A lot of people will chase foreclosure leads, and when they do the subject to, they'll cure the foreclosure. So I'll buy your property subject to, maybe you're behind in your payments by about $5,000. I'll pay the payments to catch it up, and then buy your house subject to at the same time. And so they'll look at foreclosure leads and things like that to find those people. Yeah, a lot of people do it with website ads. Lots of different ways to do it. Yeah. Yes, sir.
Just a point that most people probably don't know, your credit report
Yeah.
or an American emigrating out, it doesn't matter what happens to their credit report here if they're not intending to come back here.
That's a great solution for a lot of things. You get all these new credit cards, rack them all up, and move to Britain, right? Yeah. Yes, question.
Is that legal advice?
Yeah, right.
So, in the scenario that you gave, giving him a $10,000 overage to do that, is there a best practice for giving him that money? Is it to just like you would give that $10,000 extra at title and think it's dispersed?
Yeah, you do it at closing. Yeah, so a lot of subject twos are written like this. They'll say, I'm going to pay you whatever is owed on your mortgage. That's the purchase price plus $5,000. So the seller walks with $5,000, $10,000, whatever it is. Yeah, and it's all done at the title. Yeah. Yes, ma'am.
I might have missed what you said earlier about the foreclosures, and they could just end up somebody in foreclosure can get away with the deal after you put the payment.
Yeah, so with any of these types of transactions, when you're dealing with people that are in foreclosure, you have to use the Colorado Foreclosure Protection Act contract language. They have a right to cancel after 3 days, and they've got some warnings that are in the contract. Provided that you use that and that you cure the foreclosure at the time of the closing, you're fine.
So that language just has to be in the contract.
Yeah, it has to be in the contract. So how many of you use the standard contract for your investment deals? Who doesn't? Who hates it? So one of the other things that I have as my stuff that works is use the Colorado real estate contract. I would highly recommend that you use it. Lots of times you're offering cash and you're not doing inspections, you're not doing appraisals, you're not doing all those other things that are in there as contingencies, and that's okay. Just cross them out. What's great about the Colorado real estate contract is if you're in a dispute with a buyer or a seller, and let's just say I'm the trial attorney that is saying that you did a bad thing, and I've got you on the witness stand, and I say, hey, can you take a look at this this document? And you go, yeah, what's that? And I say, isn't this the contract that you used? This 2-page contract? Isn't this the contract that you used? Yeah. And didn't you get that contract at the Get Rich Quick seminar at such and such Nebraska? Right? And you say, what do you have to say? Yeah. And then I say, well, there is a contract in Colorado that all the real estate professionals are required to use. How come you didn't use that? And so that's one reason that I really like the Colorado real estate contract, because I like to be on the witness stand and say, oh, yes, sir, that is my contract. It's the same contract that every real estate broker in Colorado is required to use. And that's why I use it. It's a very fair contract, right? I'd like to be that guy instead of the one that's using the totally one-sided contract. The reason most people don't use the Colorado real estate contract is why? Money. Tell me.
Too long.
It's too long. Yeah, it is too long. That's why you cross out all that junk, right? So I like to be able to sit across from a for sale by owner and say, I'm going to present to you the contract that we discussed. And I jump right to the price. Remember, I told you that I paid $200,000. And then I jump right to the additional provision that I say, remember I told you I'd pay all closing costs, I do this, I do that, I do this. And I say, yep. And I say, okay, now I'm going to go start from the beginning of the contract and go through all this. This is the same contract that every real estate professional is required to use in Colorado, and that's why I use it. And then I walk them through the contract. And the places that are not applicable, they're crossed out. Like inspection periods and things like that if you're not using those. And I think it gives you a lot more weight sometimes to use it because how many have been you present a contract to a for sale by owner and they say I'm going to have my attorney review it, right? That's fantastic. I think you should and they'll recognize it because it's the same contract that every real estate professional in Colorado uses. Do you think they're really having their attorney review it most of the time? No, they're just telling you that because they're using that higher authority negotiation tool, right? And this really eliminates that objection. Questions on that?
That's one off the door side?
Yep, it's off the door side. Yeah, really easy to use. If you guys are looking if you're doing wholesaling or any kind of thing like that, where you're looking for assignment language or disclosures to put in your contract, I'm happy to provide mine. That's like 6 or 7 disclosures that I always recommend every investor use. So just email me and I'll send that to you. My email is Greg, G-R-E-G, just one G at the end, at firstalliancetitle.com. First is spelled out. Okay, any other questions unrelated to what we're doing? I'll keep going. I've got a couple more on my stuff that works. Okay. Wraps. So let's say I'm dealing with a seller that likes the idea of a subject to, but doesn't trust that I'm going to make the payments. And if I don't make the payments, they want their property back. So, or let's say that that seller is agreeing to the subject to on the payments, but they want more money. They want to be paid every month too, in addition to the underlying lender. So that's when we do what's called a wrap. So it's a subject to, but then we are doing a loan from the seller secured by a deed of trust. So it's like a second loan or a third loan if they've already got two loans. And what that does is it says, typically they're mirror wraps, meaning if the seller's mortgage payment is, or underlying loan is $200,000 loan and the mortgage payment is $1,200 a month, let's say. My wrap loan would say, I promise to pay you, seller, the exact same amount of money that's required under the other note every single month. And you're promising to pay it to your lender. And a matter of fact, we're going to agree in this document that I can just pay it directly to your lender and you're okay with that. And so now I have a promissory note with the seller that I'm promising to make these mortgage payments to the seller. And I'm really making them to the lender, right? And if I don't make them, the seller can foreclose on me and get their property back. I like wraps, especially like wraps if you are a licensed professional like a broker doing those deals, because the Division of Real Estate is very attuned to consumer protection. They don't like subject tos because people can be harmed by them. But with a wrap, it gives that seller extra protection. So anytime I'm dealing with a real estate broker, I encourage wraps. I encourage them anyway. I just think it's really easy to do. A couple extra documents, but it's the same thing as a subject to. Question on that? Yeah.
At the beginning of that scenario, you said that if the seller wanted to get payments monthly.
Yeah, so another way we could do that is we could say, okay, I'm going to pay the underlying mortgage, subject to, but I'm doing a brand new note now, interest-only note of $10,000, and I'm going to pay the seller under that note until I sell the property, or for 30 years or whatever. So it's just an extra income stream that the seller can get from the second or third loan. Just like a normal seller carry finance, really. Yeah. See, these subject twos and wraps, they take so many different little turns and twists, and there's so many different ways to do them. Yeah.
So then could the seller refinance at all during that time?
I'm sorry?
Could the seller refinance since they still have
Could the seller refinance? No, the seller's not on title anymore. So great, I'm so glad you brought that up. Thank you. So here's a challenge for you. You really like this property. The seller wants to do a deal with you, and as the buyer, the seller's willing to lease it to you with an option to purchase, but they're not so sure about selling it to you. As a buyer, the reason I don't want to do a lease with an option to purchase is I'm not sure what's going to happen to that title while that seller is still on title. What if they get some other loan? What if they don't file their taxes and there's a big IRS lien? That will impede my ability to buy that property. Even if I've got an option to purchase, I'm not going to be able to exercise that option because the seller just will not be able to sell it because they have to pay off this $1 million tax lien, for example. So as a buyer in real estate, I want title. So that's why I want to do a subject to or a wrap or seller carry or just buy it. I want title. As a seller, I don't want to give up title. So as a seller, I might say to you, yeah, I like the fact that you want to buy my property. Let's do a lease with an option to purchase because I want to be able to evict you I don't want to have to foreclose on you. So, depending on who you are and asking me those questions, what's better or what's worse, it's going to depend on whether you're the buyer or the seller. You want title if you're a buyer for sure. Yeah, that's a great point. Thank you. All right, so let me talk about options to purchase. Does anybody do these sandwich lease options or any leases with options to purchase? These can be pretty effective. So if I have a lease, let's say I have a rental, I've got a couple rentals, and if I wanted to, one of them was a lease with an option to purchase, and I had an installment land contract on one once. So some buyers really want that feeling like they're purchasing the property. They really want that, some renters. And they're willing to pay extra for it sometimes. So if they are, then what you can do is you can have a lease with an option to purchase that property at a certain amount within a certain amount of time. And you can collect that option fee right up front. So it's kind of nice because you don't just get the security deposit, you get another $8,000 or whatever it is that kind of locks you, the landlord, into selling that property at that agreed upon price within a certain amount of time. If you've done a lot of research on options, you know that people rarely exercise them. What typically happens is the renter figures out, well, I don't really like this property anymore. I've lived here for 3 years and I don't like it anymore. And so they might come to you and say, well, we're just going to leave anyway. But what you need to be able to prevent them from doing is saying, hey, by the way, since I'm not buying, give me my money back. They don't get their money back, okay? But you have to structure it correctly so that they don't get their money back. So there's two things that you want to do here. One is you want to do an upfront option fee. And you don't want it tied to anything but an option. You don't want it to be extra rent each month. You don't want like, hey, your option could be paid over a certain amount of time. And each month a little bit goes in there. You don't want your option to be used to credit at closing the purchase price. You just want it completely standalone. They're paying an extra $8,000 or whatever the amount is, just for the option to be able to buy your property when they at that price. Okay, so that's like the most critical thing. If you structure it as a rent to own, where a little bit of their money every single month starts to go to the down payment, what you're doing with that is they're developing equity in that property. And whenever anyone starts developing equity, and then you try to evict them, they have a really good case that you can't evict them because they've got an ownership interest in the property, an equitable interest. You have to foreclose on them. So your eviction that used to cost you, $400 to get them out of in county court is now going to cost you, $4,000 at a minimum to foreclose on them in district court, because that would be a judicial foreclosure, not a public trustee foreclosure. So having that option separate is really, really critical. And so you're going to have a lease agreement and you're going to have an option agreement, and they're going to be tied together. Let me tell you how they're tied together. So what you have to have in your lease agreement is, if you default on this lease, your option goes away. I've seen a case where the tenant was evicted, and then they recorded their option with the county, and the option didn't go away. They paid their option fee, and performance of the lease wasn't additional consideration for that. And so they actually had that option, and they were able to tie that property up legally until that landlord paid them back their money in order to sell the property. So your option fee has to be tied to your lease, so that part of the consideration for the option is that they are in full compliance with their lease. Okay? So those are the two option points. What else? Yeah.
How do you make, because normally a lease is like a year, right? So how do you make the default on the lease a year after that year? How do you include that in the contract? Is it a
So if I have
lease?
So if I have an option agreement and a lease, my option agreement says you can buy this property anytime within the next 2 years.
Okay.
And I have a lease that's a year. And I would renew my lease if they're a good tenant, but if they don't make payments and I evict them, I don't want them to have that 2-year option still.
Right.
So what it has to say is, If you're in default on your lease, your option goes away. Yes?
What would you consider default as far as how many days, or like a month, or a few days, 5 days?
The default would be whatever's in the lease. So to default under the lease is going to spell that out. Usually you've got a late payment period, and they'll make their payment. If they don't, then you can evict them, right?
So you would say 5 days or something like that?
Yeah, exactly what's in your lease agreement. Yeah.
What do you typically do?
So in my lease agreement, it's 5 days for late payment. So if the payment's not there within 5 days, then it's late. And well, when you try to evict somebody because of a payment like that, they're just going to pay you typically, and you just want the money, right? So if you were to accept the money, they're still in the lease. And later on, you couldn't say, "Oh well, that one time you were late, sorry, you ruined your option." You couldn't do that.
Okay.
That'd be bad. Yeah. Nice try. Yes.
So you made a mention of installment land contract versus lease with option to purchase. Elaborate on the difference.
Yes. So a lease with option to purchase just is a lease. Installment land contract is you're actually making installment payments toward the purchase. And when you finish all the payments, kind of like a mortgage, you own the property. Right? They used to be really big in the 80s. In fact, the Real Estate Commission used to have forms that real estate brokers were able to use for installment land contracts. And they just got too complicated, so they took that away and didn't allow them to use them anymore. They're still legal, but the real estate brokers aren't allowed to. They don't have the forms available to them anymore. Let me give you another example on especially these multi-unit properties and things like that with the use of options. They're really, really powerful. So whenever you're buying and selling with multi-units, your seller is typically looking to 1031 exchange their funds into something else because they're looking for tax-deferred treatment, right? So sometimes what will happen is if I'm a seller and I want to 1031 my money into another project, and that project's not done yet, I could run out of time with my 1031 if I sell too soon, right? So we did a really cool transaction a couple of years ago where the seller needed more time, so we did a lease, a full management lease of like a 30-plus unit building, and that full management lease allowed the buyer to come in, take over everything, start innovating units, start charging rent, collecting all the rent. It was all theirs. They paid all the taxes, everything. But it was just an option, the lease with an option to purchase at that time. So the reason they did the option to purchase was they're waiting for the seller to identify his replacement property. So as soon as he was able to identify his replacement property, then they exercised the option so that he could roll all those funds into the next property. Had they just bought it outright first, then they would have had to, he would have had to identify that property right away. It was a big deal, and he wasn't sure he could identify it. And if he couldn't identify it, all that gain becomes taxable. So it's a huge benefit sometimes with 1031 exchanges that a lot of people just don't know. And for the buyer in this particular case, it was really cool because he basically almost rented this entire place and had it all like re-rented before he actually purchased the property. He was paying rent, but he was also collecting rents. So he was cash flowing and he was paying, some out-of-pocket expenses for the renovations. But he was in total control of this place. And then so by the time he bought it, everything's done. It was a fantastic deal for him.
And so the appraised value had increased by the time.
Oh yeah. So then it gets the loan and the appraisal's there, and it's boom.
Awesome.
So much better. So the appraisal paid for all the renovations.
And he already had increased income, but it wasn't seasoned.
Yeah, so it's just a really, really good scenario. And you have to pay attention to that when you're buying from investors. What is their exit strategy, and can you help them figure this out? Because they don't know it. We had to show the seller what we got together and said, hey seller, what if we did this? And the seller was like, oh my God, that solves all my problems. It really did solve all their problems. Yeah.
Yeah, presumably if you're buying on lease option, you need to clarify for some manner to stop selling to somebody else.
Yeah, if you're buying with a lease option, you can record a memorandum of option to cloud that. Yep, you can do that. Oh, another way that the lease options work pretty well that I've seen, and this is mostly for real estate brokers. We've had a lot of situations where the market's so tight right now with inventory. It's really hard for the sellers to find replacement homes, right? So they sell their property, and now they're looking for a replacement home, and they're struggling. So, and then the worst case scenario is when you've got these daisy chain transactions where, buyer's going to buy my property, and now I'm going to use that money to buy the next property, and then the next person's to the next property, the next person's to the next property. And if my buyer falls out, it kills all these deals, right? So sometimes what we'll do is occasionally the reason that it's falling out on the buy side doesn't have anything to do with the buyer's credit. It's maybe that the funds aren't in time from like an account that they had to liquidate. Maybe the title needs to season longer. Maybe they're needing to change loan programs or something and they need more time, but they're a qualified buyer. So in that case, rather than everything just getting destroyed, you can do a lease with an option. So you're under contract because you basically have a contract to purchase. That buyer has a contract for purchase. Attached to that contract for purchase is a lease. And it says, and then the purchase closing date is moved out a little bit. So it's saying, hey, I'm going to move in at such and such time, and once I do, I'm bound by this lease, and if I don't close by such and such day, then the lease expires and I have to get out. So it's a way for buyers to get into the properties when they normally couldn't, and be able to occupy the properties, and then exercise that option. So we've seen that used in a few different cases, and it can be pretty helpful sometimes. Yes, sir.
Presumably you then have to have a daisy chain release option because those got capital.
Yeah, unless I think in the last one that we did, they had enough. They were willing to bring enough to the table to make it work for the seller. Like they had just enough to move it on, and so they were able to do that. Yeah, but the buyer wasn't going to do it unless they really knew they were locked in, and so they wanted to move in. They had, they'd already given notice they needed to move in. Well, I can open it up. What else you guys want to know? Yes.
I have a question. So, I just talked to an accountant, and I had purchased a piece of property with my 401k as 50% partners, and he's like, that is illegal. And he's like, I will not help you. That is illegal because you are personally benefiting from the transaction.
Yeah.
But the bank that I worked with didn't have a problem. The title, I felt like I was doing the right thing. He said, you need to talk to an attorney. So
you are on title as a co-owner with your 401k?
Yes.
Yeah, that's a self-dealing. So it's just like an IRA. You can buy properties in your IRA, but you can't own them also. And you can't sell them to people in your relatives. There's certain restrictions on self-dealing, and that's what it is. So yeah, so it's not illegal. It just means you're gonna have to pay taxes on it.
That's
possibly.
what he said.
Yeah, so all that 401k money that was used might be a tax hit.
That's what he said.
Yeah, sorry.
Oh, I need another opinion.
Yeah, buy her a drink right now. She needs to. So with IRAs or 401ks that have self admin, you can buy a property and you can get a loan. I think First Bank does them, and just a few others that do non-recourse loans with IRAs. Anybody else in here do a non-recourse loan? So you can buy those with your IRA, but you can't be an owner.
Should I sell it? Do you think by selling it before the does that make any difference whether
you're done? You're
toast?
You've already you're gonna have to pay tax on that. Yes.
What do you do? Put that in an LLC then, or what's the way to?
If you were buying it, you could own it individually, or with your LLC. Your IRA could just own it as an IRA. The account holds it. It's titled in the name of the IRA. Yeah. Now some people do these LLC checkbook IRAs, and so they have the check writing ability on their IRAs. I'm not a huge fan of those. I think there's some risk to those, but you can do it. Yeah.
Just in her situation, is there any way that she could transfer the IRA to a 401k, a solo 401k, and then undo the new transaction? Or is there
Well, the problem is she already did the transaction, and so you're kind of hosed. Yeah. It's kind of like a 1031 where you can't undo it after you purchased it. So if you give them monthly, so if you sell your investment property and then you take the money and you go, oh shoot, I should have done 1031. I'm just going to send this to 1031. You've really taken the money. It's taxable at that point. Yeah. Ask a CPA. I think you're going to pay some tax on that. Yeah, anytime you got those deals, any CPAs in the room? I've got a really good one, and she works tons with just investors, real estate investors. She works a lot with real estate investors. And anytime I have a deal that I think would be questionable, I will call her and say, what do you think about this? And they will save you thousands of dollars. So we've had some great success with our CPA is Sherry Christian. Sherry. S-H-E. I can't remember if it's R-R-Y or R-R-I. I think it's Y. Her last name's Christian. If you email me, I'll send you her stuff.
What part of town is she in?
She's in Cherry Creek. And she's off off Colorado Boulevard, not like in Cherry Creek, like off the other way, so it's not a traffic disaster. Yeah. Anything else? Any other questions? Yes.
Okay, this may not be your exact area, but this is something we've been talking about and I'm curious about. And I think you alluded to it earlier. Getting back to notes and difference between land contracts and mortgages. Land contracts seem like they're a lot more flexible in language, but more and more people don't like them as much as mortgages. Is it to do with the language you said that can cause invalidate the land, or like behavior that can validate the land contract?
Yeah. So land contracts. The difference between a land contract and a mortgage. We're using the term mortgage loosely. In Colorado, it's a deed of trust, right?
Yeah.
But it's a promissory note secured by a deed of trust on the property. A land installment contract, there's really no security against the property, so they're kind of a seller tool, not a buyer tool. And the reason I don't like them is if somebody defaults on a land installment contract, you may have to judicially foreclose on them rather than evict them. So I always ask my sellers this when they're asking about doing an installment land contract. They'll say, hey, I want to do an ILC. And I'll say, why? And they'll go, well, because the buyer really wants to feel like they own it and they like this installment land contract thing. And I'll say, well, why don't you tell them that when they're ready to buy it with real money, they should just buy it. Instead, just rent it. Or maybe rent it with an option to purchase. That way, a rent with a clean option to purchase, it's crystal clear that you can evict them. As long as you've done the option to purchase well. But we want to be able to evict the tenants. We don't want to have to judicially foreclose on them. That takes a ton of money and a ton of time.
But if you have a promissory note and deed of trust, then you would have to judicially.
But with a promissory note and deed of trust, you can call a trustee foreclose on them, which is the one that we're all familiar with in Colorado, and it's really easy and it's
so
much less expensive.
Worse if you have to judicial foreclosure.
Yeah, judicial foreclosure is when you go to the district court and have the district court do the same thing that the public trustee office does. It takes a lot more time, costs a lot more money.
Okay, so land contracts, even if you're a non-judicial state, you could end up having judicial foreclosure.
You could, yeah, that's why I don't do it.
Okay, we've been asking, nobody's given us, I would have an answer.
And just as an aside, the other thing you have to be aware of, and there may be some changes to Dodd-Frank and stuff like that, but it used to be we could sell as investors to any buyer, owner buyer, with seller finance terms, at whatever terms we really wanted. And now we can't. Dodd-Frank has placed some restrictions on that. So if we are doing a seller finance with a buyer, a real seller finance, and that buyer is going to live there, we have to be very careful that we're not violating Dodd-Frank. Typically for an investor to be able to do like 3 deals a year, and that's it. And you have to have there's some restrictions on whether you can do balloon notes and things like that and interest rates. In this market, I don't have a lot of people saying I want to sell or finance to a buyer because they'd rather rent because they're getting such massive cash flow on their rents. Like, why sell it now when you can rent and sell it later, sell it next year for 8% higher? You know what I mean? So I don't get as many people doing seller finance on the seller's side as I used to. Yeah?
Would we right to say Dodd-Frank not apply to multifamily?
It does not. But if you're selling like if you own a condominium and then you're converting condos and selling them individually, you wouldn't want to be lending on seller finance on those. Yeah, you'd be restricted.
So, let's say that there's some people, they are in the process of being evicted because foreclosure. And they decide to go ahead and give you a quick claim deed. What would you do right after that? I mean, if they're willing to stay there and pay rent, or what would you do anyway?
Oh, if somebody is in foreclosure and they're willing to give me a quick claim deed, well, as we talked about before, you have to comply with the Foreclosure Protection Act. And so you have to do that, so I would contract with you correctly to do that if I wanted to take over your property. But I wouldn't let you stay there.
Okay.
That's another thing with the Colorado Foreclosure Protection Act. It is when you buy those properties, don't do a lease with an option to purchase. That's what the Ryan Searle guy did. That's so problematic. And the statute prohibits that unless it's really specific on your lease. You have to prove that they can pay. They get all these outs. They can default a number of times. It's really bad. So any seller that is just insistent on staying there, find a different property. That's what I get. Lots of investors like, man, this is such a good deal, but the seller, to make this happen, they just got to be there. Well, what if I buy it and then I lease it to my friend, and then my friend leases it back to the person and lets them stay there? They're trying everything they can to let that seller stay in. It just doesn't work. So just move on to the next property. Yeah, that's a tough one. Used to work. Well, anything else? I was just going to so this is how I work, and I just want to kind of just give you guys a framework for that. So my job day to day, I run the title company, but my 90% of my time is doing things like this, or answering calls and talking with people about deal structure. I'm happy to do that. So if you have a question on a deal and you want to run it by me, feel free to call me, and I'm not gonna charge you for it as an attorney. But if we get to a structure where, okay, I'm going to help you create these documents and such, then we can talk about an arrangement to do that. So I'm not kidding about that. My phone number is 303-523-5092. That's my cell. If I don't answer, it's because I didn't want to answer. But I'll get back to you. Here's what I don't do, just so you know. What I don't do is meet. Yeah, 303-523-5092. What I don't do with investors is I get these calls where they want to meet me, interview me as an attorney and or title company to see if I'm okay doing creative transactions and to review maybe some of their paperwork, their contracts that they're using. I don't do that. And here's why I don't do it. Most of the people that have me do that, they're never really good, just trying to get all the information about wanting to invest. They're actually not going to become investors. They're studying to become investors for the rest of their lives. So the people that I'm totally willing to sit down and talk to are the ones that have a deal. You have a deal, and it's like, hey, Greg, I got this deal. I need to figure out how to get it done. I'm happy to work with you on that because it's beneficial for both of us. I actually have real terms that we can talk about. It's not like this, well, if you did this, then you could do that, or if you did, it's real. It's not a pretend deal. Also, I'm not a big fan of most of these investor contracts that people pull from different sources and say, hey, can you just review this and see if it's okay in Colorado to use? Instead, what I'll do is I'll take it and I'll shred it up. I'll give you the Colorado contract with a bunch of disclosures and say just use this instead. I'll send that out to you if you want me to do that. So that's kind of how I work with people, and would love to do business with you guys. Our title company has closers that I've worked with since 2004. They have come along with me all the way through to multiple companies, and they're absolutely fantastic. We've got a phenomenal staff. So they've got lots of expertise and when you call them and ask them about a subject to or a wrap, they know exactly what you're talking about. And that's not going to happen when you pick up the phone book and call most of the larger title companies in the state. Okay?
Do we do trust?
Do I do trusts? I don't do trusts. I used to do estate planning and trusts as well as that. And I used to do trusts for real estate too. I just don't do that anymore. I have a colleague that does tons of living trusts. So if you want his name's Bruce. And I'd have to send you his contact information. But Bruce does lots of living trusts for real estate investors because they've got different properties all over the place, and he just sticks them all in a living trust so that when if something happens, you don't have to probate a whole bunch of different little properties. Yeah.
Would you advise trust an LLC?
That kind of depends on what your purpose is. Whether you want to do a trust or an LLC. Sometimes with trusts, it's more of just keeping all the assets so that they don't go through probate. And with an LLC, it's more of a liability issue. You're trying to protect against somebody coming after your personal money. I'm not a huge fan of these real creative asset protection methodologies. Lots of times when people are trying to do those, they're trying to do them after they bought their first rental property, and they really don't have a lot of assets to protect, quite frankly. And an LLC is perfect at doing it as long as you treat it as a company. You're treating it as a real company. You've got a company bank account. You're not commingling accounts and things, and you've got insurance. Most of the time, your landlord's policy of insurance and an umbrella policy is going to go a long way to covering you for liabilities. So, as you go down that road of real creative asset protection, you're going to have to ask yourself at some point, man, how many tax returns is this going to require? How much is it going to cost me to do? And how much of a headache is it going to take me to be able to keep up with this stuff? And am I really getting the benefit for the hassle? Right? And I think in most cases, no. Most like high-level investors that I know that have hundreds of properties, half of them have them just in their LLC. Some of them have their individual names. But most of them just have one or two LLCs that they buy everything in. And they just run it as a business. And
So that's like say 2 or 3 LLCs. Advise them to set up separate business bank accounts for each one.
oh yeah, you would. Yep. Yeah, the question was if you have different LLCs, do you need separate bank accounts? Absolutely. Yeah. So you can see how that could be a pain if you did an LLC for every single rental and you had all these different bank accounts and all these different K1s.
So would you have them all in the same bank, or would you advise one or the other?
Oh, I don't think it matters. Yeah, not the same bank. I would. As soon as you get a portfolio of rentals and you start using one bank, they start to become very friendly with lending. Deposits are a big deal. Our bankers are our best friends because as a title company, you've got this escrow account that's everybody else's money in this escrow account, right? So of course there's millions of dollars floating there all the time. Banks love us, right? So they'll also love people that do a lot of property management that have all that money coming in and people that got a lot of properties. Leverage that relationship for sure. That it? All right, well, I'll hang around. If you guys have any questions or anything like that, I'd love to talk to you about it. Thanks for having me today.
Well, just right now, you guys can all network. We got the place till 2 o'clock, so yeah, feel free to network and, yeah. Thank you, Greg.
Yeah.